Okay, so today we will be talking about Chapter 3. Chapter 3 is dealing with job order costing, cost flows, and external reporting. And some of this, I believe, is review from what we looked at back in Chapter 2, which is okay, because it'll be good for you, good for us to go over it. So let me go ahead and pull up the PowerPoint here. So we're going to go over a little bit of vocab first. And again, some of this was talked about in the last chapter, but we didn't really go over. Um, we talked a little bit about it last chapter. So the first thing is job order costing. Remember that that is a costing system that's going to be used in situations where many different products, jobs, or services are produced each period. And they are more or less a custom type thing. So you have job order costing and then you have process costing. And we haven't talked about process costing yet. We will upcoming. And then absorption costing is a costing method that includes all of the manufacturing costs, which would be the direct materials, direct labor, and then both variable and fixed overhead costs within the cost of the product. The allocation base then is the measure of activity such as direct labor hours or the machine hours that is used to assign costs to cost objects. So that's the allocation base. And then the predetermined overhead rate is the rate that is used to charge manufacturing overhead cost to jobs that is estimated in advance for each period. It is computed using the following equation that we see, which is estimated total manufacturing overhead cost divided by the estimated total amount of the allocation base. And that's what gets us that. And then we talked about, I touched on that a little bit earlier, that because this is done, the predetermined overhead rate is determined in advance of each period, it may or may not be an accurate representation. It is as accurate of a representation as we can get, but we know that things can sometimes change as you go through an actual period. And then the overhead application is the process of assigning the overhead costs to specific jobs, and you can do that using the following formula, which is the predetermined overhead rate multiplied by the amount of the allocation base incurred by the job. Then we have normal costing, which is a costing system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of the allocation base that was incurred in each job. And then a job cost sheet, and we looked at this last week in the last chapter, is a form that records the direct materials, direct labor, and manufacturing overhead costs charged to each job. It's either a paper form that gets filled out. It could be something, as we showed you, could be something that's filled out on the computer, but it is a sheet that records all of the direct materials, direct labor, and a manufacturing overhead that went into that specific job. Okay. So some key definitions now into now how we understand the flows of costs and how that's going to work. So, and then remember from accounting, we're going to talk a little bit about it. Remember from accounting 4A, you did journal entries and we talked about, the T accounts and debits and credits. We'll get into some of that here as well. Again. So raw materials are going to be the materials that go into the final product. So let's say that you are baking bread that you're going to use. So the raw materials, that would be like the flour, the water, the whatever, the yeast, whatever else goes into baking bread. Now, work in progress is the units of production that are only partially complete and they'll require further work before they are ready for a customer. So I remember in another textbook that I used, we talked about, um, and I don't think it wasn't, maybe it was job order. They talked about making drumsticks, like to play the drums. And they said that they had to sand them down, cut the wood into dowel, into pieces. They sand them down and form them. If that's all they did at that one step, they're not completed yet. They're not ready for sale. They still have to be packaged. They actually have to, which I didn't know, and I learned it reading. You actually have to match the drumsticks up to make sure that they make the same tone. I didn't know that you had to do that. I'm not a drummer, so go figure. All of that would be stuff that's done, could be done at a later point in time. So it'd be work in progress until it was actually completed and ready for sale. Okay. And then finished goods consists of completed units of product that have not been sold to customers. So if you have something, it's ready to go, but you haven't actually sold it yet, but it's finished goods. And then the cost of goods manufactured includes all of the manufacturing costs associated with goods that were finished during that particular period. And again, that's important because, again, the period could be the month, it could be the year. And so, for example, for a lot of companies, if they do work from January to December as their fiscal, well, obviously, we just started a new month. We just started a new year here in January. So we want to know what we did within, let's say, 2024, because we're doing taxes and things dealing with that. So you would keep that separate from whatever you're doing now in 25. But cost of goods manufactured is everything involved with the manufacturing within that particular period. Okay. So here we see that the raw material purchases are recorded in the raw materials inventory sheet, inventory account, which raw materials inventory, so purchases get recorded in the raw materials inventory account. And that, of course, is a balance sheet account. And then when raw materials are used, they uh, in production as direct materials, their costs are transferred to the work in progress inventory account. So we still have them, they just get transferred into another account. So credited to the direct raw material inventory credit, and then we can debit our work in progress inventory to add it to work in progress. Okay. Now, to transform the direct materials into completed jobs, direct labor is added to the work in progress inventory account. So we would have to include that. So our direct labor. Okay. So you would debit work in progress inventory credit direct labor. And then manufacturing overhead cost is applied to work in progress by multiplying the predetermined overhead rate by the actual quantity of the allocation base. Okay, so all those things would go into your work in progress inventory. And then once the jobs are complete, their costs then would be transferred from the work in progress inventory account into the finished goods inventory account. And then the amount that was transferred from the work in progress inventory account to the finished goods inventory account would be referred to as the cost of goods manufactured. So once we've manufactured them, we've taken account of that. Now, as goods are sold, then their costs get transferred from the finished goods inventory account, then, which is on the balance sheet, into our cost of goods sold account, which would then affect our income statement. Then we might have period costs. such as selling and administrative expenses, that they do not flow through inventories on the balance sheet. They would be recorded as expenses on the income statement in the period incurred. So the CEO's salary, rent for the office building, the phone bill for the office, anything like that would just it would bypass this. It would just go straight to selling administrative expenses because that's what it is. Okay, so we have another way of looking at it. So now, okay. So first of all, these are the transactions that we're going to take a look at, and then I'll show you on our T accounts. So to illustrate the cost flows within a job order costing system, we will record Ruger Corporation's transactions for the month of April. Ruger is a producer of gold and silver commemorative medallions, and it worked on only 2 jobs during the month of April. Job 1 was a special minting of 1,000 gold medallions commemorating the invention of motion pictures, was started during March and it was completed in April. As of March 31, Job A had been assigned 30,000 in manufacturing costs, which correspond with Ruger's work in progress balance on April the 1st of 30,000. And then Job B was an order of 10,000 silver medallions commemorating the fall of the Berlin Wall. That was started in April, and it was incomplete at the end of the month. So they had started it in April, went through April doing it, but they were not able to finish it all in April. So okay, so the first thing that we have to do is we have to purchase our raw materials. So the cost of raw materials purchases is debited, and although not shown, the credit side of the transaction would be to accounts payable. Oh yeah, we don't have the account here. So you would debit raw materials for materials purchases, and then you would credit accounts payable, or it could be cash if they paid cash, but you would do that. So that's this first part here for raw materials. The cost of direct material requisitioned is debited to the work in progress and then added to the job sheet to serve as a subsidiary ledger. So we would debit work in progress for anything what we're taking out of raw materials to work on and use. And then we would credit our direct material or credit raw materials for what we're taking out and what we're using. Okay, remember there always has to be a debit and a credit. And then you would have the cost of indirect material requisitions would debit manufacturing overhead. So you would debit manufacturing overhead, and then you would credit raw materials. So that would be for things such as maybe oil to oil a machine or anything like that, that it's not directly going into an item, but it's still inventory that we're and materials that we're using in our facility. So we see here that first, the purchase of raw materials. So they purchased 60,000 of raw materials. So we would debit our raw materials account, and then we would credit accounts payable or however they paid it. And then during April, materials requisition forms were prepared to authorize withdrawing 52,000 of raw materials from the storeroom to use in production. These raw materials, 50,000 of it was direct to what actually went into making the coins. And then 2,000 was indirect materials. So again, things like oil, things like rags, things like whatever else that they might have used to maintain the machines that was overhead. So 50,000 of it, we would debit work in progress to move that into work in progress. And then 2,000, we would debit manufacturing overhead to show what is used for manufacturing overhead. And then we would, which is an expense. And then we would debit credit 52,000 for raw materials because we now are removing those now from our raw materials inventory. And then to record labor. So direct labor costs are debited to work in progress and then added to the job cost sheet, which serves as the subsidiary ledger. So you would, and an indirect labor cost would be debited to manufacturing overhead. So we see that we would debit uh, work in progress for direct labor, and then we would credit wages and salaries payable, and then you would credit wages and salaries payable because that's a liability. So we credit to increase the liability. And then we would debit our manufacturing overhead for the indirect labor. So we see how that works out. And this is an example in of a journal entry. So they had employee time tickets that provide hourly summaries of each employee's activities throughout the day, included 60,000 recorded for direct labor and 15 for indirect labor. So you would debit work in progress 60,000 for the labor that actually went into the making of the coins, and then 15,000 of manufacturing overhead debit. That would be for anything overhead related that they did. And then we would credit salaries and wages payable for 75,000, and that's to increase that liability until it gets paid. And then recording actual overhead. So there might be other overhead as well besides the materials and the labor. There might be other items and other costs that are incurred. So as they are incurred, the actual manufacturing overhead costs are debited to manufacturing overhead. So would debit manufacturing overhead and then credit whatever wherever it is coming from. Okay. So we see here that the credit side of the entry is to cash or the various liability accounts. So either accounts payable or property taxes payable, or the prepaid asset accounts like prepaid insurance, so to show how much insurance is used, or the contra asset account like accumulated depreciation to be able to depreciate. So the increase in expense, we do that. So, and then again, the journal entry. So this would be to record the accounts payable for these items. They won't pay them, I guess, um, until May, the 1st of May. So they would put it in as an accounts payable for these things. So the utilities, 21,000, rent on the factory equipment of 16,000, and then miscellaneous factory overhead of 3,000. So totals 4,000. So you would debit manufacturing overhead for 4,000, and then you would credit accounts payable for 40,000. And then we see here how that would go. So we would debit our work in progress for the overhead applied, and then we would credit manufacturing overhead in order to be able to close out our manufacturing overhead for the period. The manufacturing account is a clearing account. The actual amount of overhead incurred during the period on the debit side of the account will almost certainly not equal the amount applied to work in progress as shown on the credit side of the account. This requires a year-end adjusting entry that will be discussed shortly. So, but after each month we can close it out, and but obviously there's still going to be some kind of a balance there. So just realize that again, that manufacturing overhead is a clearing account. The purpose of the clearing account is to find any discrepancy that exists between the amount of overhead that was applied to inventory and the amount of overhead that was actually incurred. Actual overhead incurred is debited to the account. Overhead applied to inventory using the predetermined rate is credited to the account. And so we see here how they did that. So they went ahead, they added it up, and they said that these were the actual costs of it. So we would debit our work in progress inventory and then credit manufacturing overhead. And then finally, in accounting for other costs that might exist. So again, we have some costs that are product costs that go directly into the product, and then we have period costs that are not related to the actual manufacturer of products, but yet they are incurred in the period. And so companies that use job order cost systems to assign manufacturing cost of products also incur non-manufacturing costs. Non-manufacturing costs should not go into the manufacturing overhead account. Non-manufacturing costs are not assigned to individual jobs. Rather, they get expensed in the period that's incurred. So, for example, the salary expense of employees that work in the marketing, selling, or administrative capacity, they would just simply be expensed in the period incurred. Advertising expenses, they get expensed in the period in which they are incurred. And then we see here examples of different areas. So the first thing is the 30,000 in selling and administrative salaries. So we would debit salaries expense 30,000 and then credits salaries and wages payable for 30,000 because we haven't, again, we're going to pay it into the following month. So that creates the liability for that. Depreciation of office equipment was 7,000. So we would debit depreciation expense 7,000, credit accumulated depreciation 7,000. And then advertising was 42,000. Other selling administrative expenses in April totaled 8,000. So you would have a debit to depreciation expense for 40, or it should say advertising expense. That's a typo. So it should say advertising expense for 42,000, and then it should say administrative expenses for 8,000. And then we would go ahead then and credit accounts payable or whatever for 50,000. But that actually is a typo there. All right. So this is how that should read, not what was there. It should be advertising expense, 42,000 debit, selling administrative expense, 8,000, and then 52 accounts payable. And then we see here how everything then we would debit our finished goods inventory once everything is done. We transfer our jobs, so we would debit cost of goods manufactured, and then we would go ahead and credit our cost of goods manufactured. So job A was completed during the month of April, and job B was incomplete. So the only thing that we would do is go ahead and let's see. So the finished goods. So you're going to have finished goods for 158,000, and then you would credit work in progress 158,000. And then job B was not completed by the end of the month. Its assigned cost will remain in work in progress and carry over to the next month. If a balance sheet were prepared at the end of April, the cost accumulated thus far for job B, which is 75,000, and that excuse me, 72,000, that would appear in the asset account work in progress. And then we see how we do that. So we would, and then once they actually go and sell the products, you would then go ahead and credit the cost of goods, credit finished goods inventory, and then debit cost of goods sold once the items are actually sold. So for Ruger Corporation, we assume that 750 of the 1,000 gold medallions were shipped to customers at the end of the month for total sales revenue of 225,000. Because 1,000 units were produced and the total cost of the job from the job cost sheets was 158,000, the unit product cost was 158,000. And so the journal entry would record the sale. All sales were on account. So you would have accounts receivable debit for 225,000. Remember that accounts receivable is an asset. They would credit our sales 225,000. And then you would debit cost of goods sold 118,005, credit finished goods 118,005. And then we'll look at how to do the schedules for all of this. But just again, remember that all inventory accounts are governed by the same logic, which is the beginning balance plus additions equals the ending balance plus transfers minus transfers out. In the case of raw materials, transfers out consists of both direct and indirect material requisitions. Direct material requisitions are added to the work in progress inventory, and direct material requisitions are debited to manufacturing overhead. Additions to work in progress consist of direct materials requisitions, direct labor, and overhead applied. Transfers out of work in progress consists of costs transferred to finished goods. Transfers out of finished goods consist of cost of goods sold. Now we're going to look at preparing the schedule of cost of goods manufactured and of costs of goods sold and an income statement. So the schedules of cost of goods sold, goods manufactured, and of cost of goods sold, they contain three different types of costs. That the costs are the costs for direct materials, direct labor, and manufacturing overhead. And the schedules calculate the manufacturing cost associated with goods that were finished during the period. So just those goods that are finished during the period. All right, so the product cost flows. So to create a schedule of cost of goods manufactured, as well as a balance sheet and income statement, it is important to understand the flow of product costs. So raw material purchases made during the period are added to beginning raw materials inventory, and the ending raw materials inventory is deducted to arrive at the raw materials used in production. So you're going to take the raw material, the amount that so it'd be the amount that is the beginning raw materials inventory plus the raw materials that were purchased equals what was available for production. Subtract from that the ending raw materials inventory, and you would get the amount of raw materials that were used in production. As items are removed from raw materials inventory and placed into the production process, they are called direct materials. Direct labor used in production and manufacturing overhead applied to production are added to the direct materials to come up with the direct manufacturing costs. So you're going to have, so to figure out the manufacturing costs, you have your direct materials, then you have your direct labor and your manufacturing overhead. That's going to then come to your direct materials or the direct manufacturing cost, total manufacturing costs. And then with that, you're going to add that to the beginning work in progress inventory, and that will get you your total work in progress for the period. And then uh, the ending work in progress inventory is deducted from the beginning work in progress inventory, and that will give you your cost of goods manufactured. And then from that, then you're going to have, so you have the cost of goods manufactured is added to the beginning finished goods inventory to arrive at the cost of goods available for sale. The ending finished goods inventory is deducted from this figure to arrive at the cost of goods sold. So we'll go ahead and do a quick check. Beginning raw materials inventory was 32,000. During the month, 276,000 of raw material was purchased. Account at the end of the month revealed that 28,000 was in raw material was still present. What would be the cost of the raw materials used? And so for that, it would be C. And the reason for that is you're going to take your beginning raw materials, which was the 32,000. You're going to add your raw materials purchased of 276,000. That gets a total of 308,000, which is what is available for production, minus our ending, which is 28,000. That means that we used 280,000 in production. So for this one, it says direct materials used in production totaled 280,000. Direct labor was 375,000, and 180,000 of manufacturing overhead was added to the production for the month. What were the total manufacturing costs incurred? So for that, you're just going to go ahead then and you can add up all three of those numbers. So you have 280,000 of direct materials, 375,000 of direct labor, 180,000 of manufacturer overhead, comes out to $835,000. And in the beginning, work in progress was 125,000. Manufacturing costs added to production for the month were 835,000. We got that from the previous question. There were 200,000 of partially finished goods that were remaining in the work in progress inventory at the end of the month. What are the cost of goods manufactured for the month? So for that, you're going to take the beginning inventory, work in progress inventory of 125,000. You're going to add to it the costs that were incurred during the month, which is 835,000. That's going to give you 960,000. Then you could subtract from that the work in progress inventory, what still remains in progress, which is the 200,000. So the cost of goods manufactured, what actually was finished during the month, was 760,000. Beginning, and then this is the number question 4. Beginning finished goods inventory was 130,000. The cost of goods manufactured for the month was 760,000, and the ending finished goods inventory was 150,000. What was the cost of goods sold for the month? And so for that, you're going to take the 130,000, which is the finished goods inventory, add to that what was manufactured during the month, which was 760,000. So that meant that 890,000 was what was available for sale. So you're going to take that total, 890,000, subtract from that the ending goods inventory, and you'll come up with how much was sold for the month. All right. So the next section we're going to do is we're going to take a little bit more of a look at our underapplied and overapplied overhead. Remember that we mentioned at the beginning that sometimes there are times where things might be misapplied, where we might not know exactly what took place, and we're going to look at that. So let's take a little bit more of a look at this. So there are two different key concepts related to this topic. And so the first of which is defining and computing underapplied overhead and overapplied overhead. So the difference between overhead costs applied in work in progress and the actual overhead costs for a period and is termed either underapplied overhead or either underapplied or overapplied overhead. So meaning what that means is that there is a possibility that what we calculate initially, which is what we used when we're figuring out our work in progress, and what actually took place may or may not work out to be exactly the same. And so because of that, either it's going to cause an underapplied overhead where we do not apply enough, or an overapplied overhead where we apply more than what we actually spent. So that's what we're going to look at here. So an underapplied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is less than the total amount of overhead actually incurred during the period. And so that means that we did not calculate enough at the beginning in order to cover us what we actually spent. And if that happens, it's an underapplied overhead. An overapplied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is greater than the total amount of overhead actually incurred during the period. Okay, and so what could happen is we could overestimate how much we actually paid, and we actually ended up using less. So it is important to understand that manufacturing overhead must be estimated at the beginning of the production period. Therefore, there most likely will be a difference between the actual and the applied overhead. A debit balance in the manufacturing overhead account indicates that more overhead has been incurred than what has been applied to the inventory. And so the overhead is underapplied. A credit balance in the manufacturing overhead account indicates that more overhead has been applied than has been incurred, and the overhead has been overapplied. So let's look at an example. So if we assume that Perco's actual overhead and direct labor hours for the year were 650,000 with a total of 170,000 hours, direct labor hours for jobs. Therefore, they had a predetermined overhead rate of $4 an hour. So if we divide that, we can get $4 an hour. Now, the amount of overhead applied to jobs during the period was 170,000, would be 170,000 direct labor hours times $4 an hour. So that's 680,000. So in this example, we would have overhead over applied by 30,000. So 680,000, which is what they actually experienced, subtracted from what they had calculated, which was the 650,000. And so that's going to give you 30,000 that is over applied. So let's look here. Let's do a couple of quick checks. So Tiger Inc. has actual manufacturing overhead costs of $1,210,000 and a predetermined overhead rate of $4 per machine hour. And they worked 290,000 machine hours during the period. So what would their overhead rate be? What should it be? So in terms of what they actually experienced. So if we take 290,000 hours times $4 an hour, that should be 1,160,000. But they calculated, or what they actually spent was 1.21 million. 1,210,000. So for that, you're going to take 1,210,000. That's what they actually experienced. Subtract from that the 1,160,000, which is what they initially had calculated. So they underapplied 50,000 in overhead. Knowing that, then what do we do with that? Knowing that if there either was an underapplied or an overapplied balance for overhead, what do we do with that? So the disposition of underapplied or overapplied overhead balances. So any remaining balance in the manufacturing overhead account, such as Paraco's 30,000 in overapplied overhead, is disposed of in one of two ways. It can be closed to the cost of goods sold, or it can be allocated between the work in progress, finished goods, and cost of goods sold in proportion to the overhead applied during the current period to the ending balances in those accounts. And so the journal entry in T account form to close out Paraco's 30,000 of overapplied overhead into the cost of goods sold would be as follows. We would debit our manufacturing overhead, and then we would credit our cost of goods sold. So that's real simple to go ahead and close that out. If we want to apply it to and allocate it to our work in progress and our finished goods and our cost of goods sold, we would do the following. So we would be calculating assume that the overhead applied in ending work in progress inventory, ending finished goods inventory, and cost of goods sold is 68,000, 204,000, and 408,000 respectively, for a total of 680,000. And so in this case, the allocation percentages for work in progress, finished goods, and cost of goods sold would be 10%, 30%, and 60%. And so the allocation would be 30,000 of the overapplied overhead would go to work in progress, 3,000 to finished goods, and 3,000 to work in progress, or 3,000 to work in progress, 9 to finished goods, 18 to cost of goods sold. And that's done in proportion. And then the journal entry that, and this is how they calculated that, is taking the amount times the percentage gives us the allocation of that 30,000. And then this would be the journal entry. We would debit our manufacturing overhead for 30,000. Then we would credit our work in progress inventory, our finished goods inventory, and the cost of goods inventory for the amount that we had calculated. And so in summary, there are two methods that you can use. One is, again, to simply close out to the cost of goods sold. The other one is to allocate the overapplied or the underapplied overhead to the work in progress, the finished goods, and the cost of goods sold. Note that, again, the latter method would be the most accurate, but it is more complex to compute. But you can do either one. You just need to be consistent in which one you're choosing. So then let's find out then, what effect would the underapplied overhead have on net operating income? It would make the net operating income higher than it should be, because we're reading one amount for overhead, which is less than what it actually was. And so that would make our net operating income be higher than it should be. So now what we're going to do is we're going to take a look at how to do our job costing utilizing Microsoft Excel. So let me go ahead and open that up for us. We're going to look at how to utilize Microsoft Excel in order to help make this a little bit easier. And this might help us too to understand some of the various calculations as well. So the first thing to remember, and again, this is going back to financial accounting, is the balance sheet equation or accounting equation. And that is assets equal liability plus stockholders' equity, or assets equal liability plus owner's equity. That is very, very important for us to kind of keep in the back of our mind as we work through this. And then how we would get our retained earnings portion of the stockholders' equity is going to be our beginning balance of our retained earnings plus our net operating income for the period minus any dividends that get paid out. That would be what our ending balance and retained earnings would be. So we have three key assumptions. They are that we will always use only use one predetermined overhead rate, that any underapplied or overapplied overhead will always be close to the cost of goods sold. So we're just going to do that. We're not going to worry about how we talked about in the last little bit ago about that there was another way you could allocate it in proportion. We're not doing that. We're just going to go ahead. If there's an underapplied or an overapplied manufacturing overhead, we're just going to go ahead and close it out to our income statement. And then if we have any positive numbers, those would increase the balance sheet. Any negative numbers would decrease the balance sheet. And remember that in our purpose, when we're working on the computer and Excel, depending on how you have it set up, if it's a number in parentheses, that would be a negative number. And it just based on the formatting that you're using in Excel. So we'll look at an example from our Sapphire company. And so the transaction template that we'll use to record the company's transactions is shown as a spreadsheet, and it reflects the beginning balance sheet account balances already for us. All of the accounts shown in the beginning balance sheet plus an account called manufacturing overhead. Manufacturing overhead is a clearing account that will always have a beginning and ending balance of 0. But we'll use it in order to calculate this. But we'll close it back out to make it go back to 0. So this account is used to record two things: an actual overhead cost, all the actual overhead costs, and the amount of manufacturing overhead that was applied to production using the predetermined overhead rate. And in the difference between the actual overhead rate and the amount of overhead that was applied to production is either the underapplied or the overapplied overhead. So let's see. Okay, so to begin our illustration, let's assume that Sapphire Company had a predetermined overhead rate of $25 per direct labor hour. That was based on a cost formula that estimated $100,000 in manufacturing overhead cost for an estimated allocation base of 4,000 direct labor hours. During January, the company completed the following transactions. And so we see that they purchased raw materials on account of 80,000. Raw materials that they used in production was 78,000. 70,000 of that was direct materials. 8,000 was indirect materials that were used, which would be for our overhead portion. They paid 135,000 in salaries and wages. 68,000 of that was direct labor. 45,000 was indirect labor or part of our overhead. And 22,000 is going to be related to our employees that were responsible for selling and administrative. So for that, selling administrative, it's not going to be involved at all in an actual manufacturer. And then they had some additional transactions, including utility costs that they had incurred to support production of 15,000 that they haven't paid yet, but they incurred them. They had uh, depreciation recorded on plant, property, and equipment of 40,000. Of that, 70% of that was related to manufacturing equipment directly, and then 30% of that was related to assets that supported selling and administration. So only really 70% of that is what we're interested in right now for figuring out our overhead. Advertising expenses of 18,000. Again, we're not worried about that to calculate overhead. That they had prepaid insurance for the month of 1,000. Of that, 80% was related to production. So 80% of that we're concerned with that they used. 20% was related to selling administration, and we're not concerned with that to figure out overhead to 20%. And then they had manufacturing overhead that they applied for the period of production of 102,500. This amount was computed by multiplying 41,000 of direct labor hours worked in January by the predetermined overhead rate of 25,000, excuse me, $25 per direct labor hour. Then they had cost of goods manufactured of 235,000, cash sales of 320,000, cost of goods sold of 245,000, cash payments to creditors of 92,000, and then they closed the over applied overhead of 5,700 to cost of goods sold. So we'll go ahead and set up our initial Excel sheet showing the beginning balances. So we see here the beginning balances on January 1st, 15,000 in cash. Okay, so we see that here. So we have our beginning balances in row 6, and then we can go ahead then and list out all of those other transactions in rows 7 through 19, A through M that we just went over, and how that's going to affect our balances and where everything needs to go. And then we can explain. So of this, we have a debit to, so of this, we had a debit of raw materials and the credit accounts payable for 80,000. And that was for the amount of raw materials that they purchased during the period. We debit the manufacturing overhead for the indirect materials of 8,000, because that's how much of it they used for that. And we would debit our work in progress inventory for 70,000. That's taking to what they used during a period, and then credit raw materials for 78,000. So they're taking the 78,000, that's what they used during the period. Of that, 8,000 was overhead, 70,000 of it was for what they actually produced. Then we would debit work in progress for 68,000, manufacturing overhead for 45,000, salaries and wages expense for 22, and then we credit cash 135, and that's to pay for those items for what they incurred in actual production expenses and what they incurred in overhead expense, wages and salary expense, and then what they paid out. And it says debits and credits to income statement accounts are shown in the spreadsheet as adjustments to retained earnings. So if we go back, we can see that. And then they would debit the manufacturing overhead for 15,000 and credit the accounts payable for that same, and that's what is D for the utilities. So we account for our utilities. And then we would debit 28,000 to manufacturing overhead, and then also debit 12,000 to depreciation expense. And then we would credit 40,000 to the accumulated depreciation on plant, property, and equipment. And that is to set up for our depreciation for what is used for the production. And then We can do our advertising expense the same way. And then also our manufacturing overhead. So we would debit manufacturing overhead for $800, and then also selling administrative expense for 200, and then credit our prepaid insurance for 1,000. And then we debit our work in progress and credit our manufacturing overhead for 102,005. We would debit our finished goods inventory and then credit work in progress inventory for 235,000. We would debit cash and credit sales revenue for 320,000 for what they sold and was paid for to cash sales. We would go ahead and debit cost of goods sold for 245,000, credit finished goods inventory for the same amount, debit accounts payable and credit cash for 92,000. That's what for the bills that they paid out, which is L. Yeah, so because they paid creditors. And then debit manufacturing overhead and credit cost of goods sold for the over applied overhead of 5,700. And so then from that, what we can do then is to create our schedule of goods manufactured. And so the schedule of cost of goods manufactured is shown here on this screen. So the cost of goods manufactured is 235,000 equals the cost of goods manufactured set up in transaction I. So if we go back, transaction I is where they did the cost of goods manufactured and how that was done. So moving from the work in progress to our finished goods. And again, we can see here everything, broken down. And then we have the schedule of cost of goods sold. So the unadjusted cost of goods sold of 245,000 equals the cost of goods sold that we set forth in transaction K, which is where we debited the cost of goods sold and credited the finished goods inventory. If I go back to the actual transaction analysis, we can see that for letter K, which is on row 17, how they did that. So they took it reduced our finished goods, and it also reduced our retained earnings for that amount because it was an expense. And then we subtract the over applied overhead of 5,700 set forth in transaction M from the unadjusted cost of goods sold. So the over applied overhead means that there was too much overhead that was added to the production during the period that they did not use. Hence, the cost of goods sold was overstated. We wanted to bring it down. And then we can go ahead then and prepare our income statement. So for that, we have an adjusted cost of goods sold then of 239,300. And then from that, we can go ahead then and create. So we have our sales, our cost of goods sold. So we had a gross margin of 80,700. We list out all of our selling and administrative expenses. That reduces the gross margin, and then that gives us an operating net income of 28,500. And so that's one way that you can use Excel then to be able to calculate all of this.